So for this session, again, we're still in our conceptual framework topic. For this particular video, we will talk about the chapter 6 of the conceptual framework, which is the measurement. So according to paragraph 6.1 of the conceptual framework, the elements recognized in financial statements are quantified in monetary terms. This requires the selection of a measurement basis. A measurement basis is an identified feature, for example, historical cost, fair value, or fulfillment value of an item being measured. Applying a measurement basis to an asset or liability creates a measure for that asset or liability and for related income and expenses. So we will talk about primarily for this chapter, we will know that it is quantified in monetary terms. Okay, so may it be dollar or peso. Okay. Selection of the measurement basis. Okay, will it be using historical cost or current value? We will also identify the feature as well as the concept of the cost constraint. The conceptual framework describes the following measurement bases. First, you have your historical cost and you have your current value. Under the current value, you have three measurements. You may either use fair value, value in use in terms of asset, and fulfillment value in terms of liability, as well as your current cost. Let's first talk about historical cost. The historical cost of an asset is the consideration paid to acquire the asset plus transaction cost. Again, the consideration paid plus transaction cost. The historical cost of a liability is the consideration received to incur the liability minus transaction cost. Again, for liability, it is the consideration received less the transaction cost. In cases where it is not possible to identify the cost, such as on transactions that are not on market terms, the resulting asset or liability is initially recognized at current value. That value becomes the assets or liabilities deemed cost for subsequent measurement at historical cost. Unlike current value, historical cost does not reflect changes in value, but is updated over time to depict the following. First, for your historical cost of an asset, you have impairment, depreciation, or amortization. You either have collections that extinguish part or all of the asset, and you have discount or premium amortization when the asset is measured at amortized cost. So for the historical cost of a liability, you have increase in the obligation resulting from the liability becoming onerous, okay? And payments or fulfillments made that extinguish part or all of the liability, and you have the discount or premium amortization when the liability is measured at amortized cost. So for the current value, again, you have three measurement bases. You have your fair value, value in use, and fulfillment value, as well as current cost. First, current value means measures reflect changes in values at the measurement date. Again, current value measures reflect changes in values at the measurement date. Unlike historical cost, current value is not derived from the price of the transaction or other event that gave rise to the asset or liability. Current value measurement bases include the following. You have your fair value, your value in use, the fulfillment value, as well as your current cost. So we will now, for the current value, we will first talk about the fair value. So what is fair value? It is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Fair value reflects the perspective of market participants, for example, your participants in a market to which the entity has access. Accordingly, it is not an entity-specific measurement. Again, it is not an entity-specific measurement. Fair value can be measured directly by observing in an active market or indirectly using measurement techniques like your cash flow based measurement techniques. Fair value is not adjusted for transaction cost. Again, fair value is not an entity specific measurement and not adjusted for transaction cost. Next, current value is your value in use for assets as well as your fair fulfillment value for your liabilities. Value in use is the present value of the cash flows or other economic benefits that an entity expects to derive from the use of an asset and from its ultimate disposal. Fulfillment value is the present value of the cash or other economic resources that an entity expects to be obliged to transfer as it fulfills a liability. Value in use and fulfillment value reflect entity-specific assumptions rather than assumptions made by market participants. Again, in a while ago, fair value, I said that the fair value is not an entity-specific measurement. However, for this case, for the value in use and your fulfillment values, these reflect entity-specific assumptions. Okay? So your value in use and fulfillment value are measured indirectly using cash flow based measurement techniques similar to those used in measuring fair value, but from an entity specific perspective rather than from a market participant perspective. Value in use and fulfillment value do not include transaction cost in acquiring an asset or incurring a liability, but include transaction cost expected to be incurred on the ultimate disposal of the asset or fulfillment of the liability. Last type of measurement basis for the current value is your current cost. Current cost of an asset is the cost of an equivalent asset at the measurement date, comprising the consideration that would be paid at the measurement date plus the transaction cost that would be incurred at that date. Current cost of a liability is the consideration that would be received from an equivalent liability at the measurement date minus the transaction cost that would be incurred at that date. Current cost and historical cost are entry values, as they reflect prices in acquiring an asset or incurring a liability, whereas fair value, value in use, and fulfillment value are exit values because they reflect prices in selling or using an asset or transferring or fulfilling a liability. Unlike historical cost, however, current cost reflects conditions at the measurement date. In some cases, current costs can only be measured indirectly, for example, by adjusting the current price of a new asset to reflect the current age and condition of the asset held by the entity. When selecting a measurement basis, it is important to consider the following. First, the nature of information provided by a particular measurement basis, and the qualitative characteristics that the cost constraint and other factors. Different measurement bases result in different information to be provided in the financial statements. For example, measuring an asset at historical cost may result in the subsequent recognition of depreciation or impairment, whereas measuring the asset at fair value would result in the subsequent recognition of gain or loss from changes in fair value. Measuring an asset at current cost may result to the recognition of holding gains and losses from price changes. Another example, measuring an asset or liability at historical cost or current cost does not result to gain or loss on initial recognition, unless the asset is impaired or the liability is onerous. Whereas, measuring an asset at fair value or value in use may result to gain or loss on initial recognition if the market in which the asset is acquired is different from the market that is the source of the prices used in measuring the asset's fair value. The initial gain or loss is the difference between the consideration paid and the fair value of the asset acquired. Another example, the historical cost and current cost measurements include transaction cost in acquiring an asset, whereas fair value measurement excludes transaction cost. Value in use measurement considers only the transaction cost on the asset's disposal. Last example, the computation of gain or loss on the derecognition of an asset depends on its measurement basis. For example, the gain or loss on the derecognition of an asset measured at historical cost is computed as the difference between the net disposal proceeds, if any, and the asset's historical cost adjusted for depreciation and impairment. Whereas, if the asset is measured at fair value, the gain or loss is the difference between the net disposal proceeds, if any, and the asset's fair value. An entity also considers whether the information provided by a particular measurement basis is useful. Information is useful if it is relevant and faithfully represented, and as far as possible, comparable, verifiable, timely, and understandable. The relevance of information is affected by, first, the characteristics of the asset or liability. Next is how the asset or liability contributes to the future cash flows. The characteristics of the asset or liability affect the relevance of the information provided by a measurement basis. For example, an asset or liability whose value is sensitive to market factors is more appropriately measured at fair value rather than at historical cost. Fair value measurement results in reporting the changes in market factors as they occur, rather than only when the asset or liability is derecognized. On the other hand, a financial asset or financial liability that is held solely for collecting or repaying contractual cash flows rather than for trading activities is more appropriately measured at amortized cost or historical cost. How the asset or liability contributes to future cash flows also affects the relevance of the information provided by a measurement basis. For example, an asset that is used in combination with the other assets to produce cash flows, like your PPE, is likely to be measured at historical cost. On the other hand, an asset that can be sold independently, like your investment in stocks, is likely to be measured at fair value. Next qualitative characteristic is your faithful representation. The level of measurement uncertainty may affect the faithful representation of information. Measurement uncertainty arises when a measure cannot be determined directly by observing prices in an active market and must instead be estimated. A high level of measurement uncertainty does not necessarily prevent the use of a measurement basis that provides relevant information. Thus, in cases where the measurement uncertainty associated with a particular measurement basis is so high that it cannot provide sufficiently faithfully represented information, it is appropriate to consider selecting a different measurement basis that would also result in relevant information. Measurement uncertainty is different from both outcome uncertainty and existence uncertainty. Outcome uncertainty arises when there is uncertainty about the amount or timing of any inflow or outflow of economic benefits that will result from an asset or liability. You also have your existence uncertainty, which arises when it is uncertain whether an asset or liability exists. Outcome uncertainty or existence uncertainty may sometimes contribute, but does not necessarily lead to measurement uncertainty. For example, there is no measurement uncertainty if an asset's fair value can be determined directly by observing prices in an active market, even if it is uncertain how much cash that asset will ultimately produce, and hence there is outcome uncertainty. Existence uncertainty may affect decisions on whether an asset or liability is to be recognized. Consistently using same measurement basis for same items either from period to period within a single entity, or your intra-comparability, or within a single period across different entities, or your inter-comparability, makes the financial statements more comparable. This does not mean, however, that a selected measurement basis should never be changed. A change is appropriate if it results in more relevant information. Because change in measurement basis can make financial statements less understandable, explanatory information should be disclosed to enable users of financial statements to understand the effect of the change. Generally, the more different measurement bases are used, the more complex the resulting information become, and hence less understandable. Using more different bases is appropriate only if it is necessary to provide useful information. Using measurement bases that result in measures that can be independently corroborated either directly, for example, observing prices, or indirectly, like checking inputs to a model, enhances verifiability. If a measure cannot be verified, explanatory information should be disclosed to enable users of financial statements to understand how the measure was determined. In some cases, it may be more appropriate to indicate the use of a different measurement basis. Depending on the facts and circumstances, the use of either historical cost or current value has its own merits in relation to verifiability. For example, in many situations, using historical cost is simpler and generally well understood and hence verifiable. However, measuring depreciation, impairment, or onerous liabilities can be subjective and hence lessens verifiability. Fair value is determined from the perspective of market participants and not from the entity's perspective, and is independent of when the asset was acquired or the liability was incurred. Thus, in principle, different entities that have access to the same markets would come up with essentially the same amount of fair value for a particular asset or liability, and hence verifiable. This could also enhance comparability because, unlike historical cost, fair value measurement results in the same amount of measure for identical assets or liabilities with different acquisition or incurrence dates. Value in use and fulfillment value are costly to implement and requires subjective assumptions. Accordingly, this may result in different measures for identical assets or liabilities by different entities. This reduces verifiability and comparability. Nonetheless, value in use may provide useful information, for example, when determining the recoverable amount of a group of assets like your cash generating unit. Current cost results in the same amount of measure for identical assets or liabilities which are acquired or incurred at different dates. This enhances comparability. However, determining current cost can be costly, complex, and subjective, thus reducing verifiability and understandability. Nonetheless, current cost may provide useful information, for example, when revaluing a property whose fair value cannot be determined directly by observing prices in an active market. Selecting an appropriate measurement basis requires the consideration of all factors in combination, including the cost constraint and other factors, rather than only a single factor in isolation. In transactions on market terms, an asset, an asset's or liabilities cost is normally similar to its fair value on initial recognition. Even so, it is still necessary to describe the measurement basis used at initial recognition because this determines whether any income or expense arises on that date. For example, measuring an asset or liability at cost does not result to any income or expenses on initial recognition except when the asset is impaired or the liability is onerous, or when income or expense arises from the recognition of a transferred asset or liability. Moreover, the initial and subsequent measurement bases usually parallel each other. For example, if historical cost is to be used subsequently, the measurement basis is also normally appropriate at initial recognition. In transactions not on market terms, measurement at historical cost may not provide faithfully represented information. Examples of transactions not on market terms include transactions in which the transaction price is affected by related party relationships or by financial distress of one of the parties, receipt of donation from another party or a grant from the government, and incurrence of a liability that is imposed by law or penalty for an act of wrongdoing. In such cases, it may be appropriate to measure the resulting asset or liability at deemed cost, like your fair value. Sometimes, it may be necessary to use more than one measurement basis in order to provide useful information. In most cases, the use of different measurement bases is applied in such a way that, first, a single measurement basis is used in the statement of financial position and statements of financial performance, and additional information is disclosed in the notes for a different measurement basis. For example, an investment property may be measured using the cost model. However, the investment property's fair value is disclosed in the notes. In some cases, however, it may be more appropriate to use a current value measurement basis for the asset or liability in the statement of financial position and a different measurement basis for the related income and expense in the statement of profit or loss. In such cases, the related total income or expense may need to be allocated to both profit or loss and other comprehensive income. For example, a debt instrument may be measured at fair value in the statement of financial position. However, the interest income is measured in relation to the instrument's amortized cost, while the fair value changes are recognized in the other comprehensive income. Total equity is not measured directly. It is simply equal to the difference between the carrying amounts of recognized assets and recognized liabilities. Financial statements are not designed to show an entity's value. Thus, the total equity cannot be expected to be equal to the entity's market value, nor the amount that can be raised from either selling or liquidating the entity. Although total equity is not measured directly, some of its components can be measured directly, like your share capital or your common stock. However, because equity is a residual amount, at least one of its components cannot be measured directly, like your retained earnings. Equity is generally positive, although some of its components may be negative, like your retained earnings can be negative if the entity has accumulated losses. In some cases, even the total equity can be negative, such as when the total liabilities exceeds total assets. A measure that cannot be observed directly needs to be estimated. One way to make the estimate is by using cash flow based measurement techniques. Such techniques are not measurement bases, but rather used in applying a measurement basis. Accordingly, when using such a technique, it is necessary to identify which measurement basis is used and the extent to which the technique reflects the factors applicable to that measurement basis. When making an estimate from a range of possible outcomes, the single amount that provides the most relevant information is usually one from within the central part of the range, which is a central estimate. However, different central estimates provide different information. For example, your statistical mean or your expected value or probability weighted average. It reflects the average amount within the entire range, giving more weight to the outcomes that are more likely. Expected value is not intended to predict the ultimate cash inflow or outflow from an asset or a liability. Next, you have your statistical median, or your maximum amount that is more likely than not to occur. It is the middle amount within the range and reflects the probability of an inflow or outflow to be no more than that amount. Next is your statistical mode, or the most likely outcome. It reflects the single most likely outcome, or it reflects the single most likely ultimate inflow or outflow from the asset or liability, which is the amount that occurs the highest number of times within the range. So here we have a range of possible outcomes consisting the, the following. You have 13, 18, 13, 14, 13, 16, 14, 21, and 13. Let's get the statistical mean. Okay. So again, statistical mean is the average. So we simply add the values. Okay, we add all of this. Okay, to get the mean, we add. Okay, we add the values and then divide the sum. Okay, the sum would be divided by the number of the values in the range. So the range composes of 9. Okay, 9 values. So the sum of this is um, get the sum of this and then divide it by 9. You would get a statistical mean of 15. Okay, so next get the median. Okay, so the statistical median is the middle value. So we simply rearrange the values in numerical order, then get the middle value. Okay, so if we rearrange this, the middle value would be 14. Okay, in case the number of values is an even number, say 10 instead of 9, as in the illustration above, the two middle values are added and divided by 2. Example, if the number of values is 10, the fifth and sixth values are added and then divided by 2 to get the median. Last, you have your statistical mode. Okay, so you just get the most frequent value. Okay, so in here you just check which number occurs the most. So in this case, it is 13 because it is displayed here 1, 2, 3, 4 times. Okay, and the rest are displayed less than 3 times. So the statistical mode would be 13. The example above is just a simplification and is only intended to help reinforce your understanding of the concepts discussed. Hence, the example should not be construed to reflect all the factors needed when applying a cash flow based measurement techniques. For example, expected values computed by applying probabilities, like your percentages, to the estimated cash flows, as well as a risk adjustment for possible variations in those estimates, and a consideration of the time value of money. Okay. So the cash flow based measurement techniques using your statistical mean, median, mode are just examples.